When the judges start betting on the game, everyone loses. On April 12, 2007, Moody's Investors Service published a report upgrading the credit rating of residential mortgage-backed securities from AA to AAA, declaring them among the safest investments available to institutional investors. The analysis was thorough, the mathematical models were sophisticated, and the conclusions appeared soundly based on historical data and rigorous statistical analysis. But there was one crucial detail that Moody's didn't disclose in their report. The agency had been steadily acquiring real estate investments since 2004, building a portfolio worth over $800 million in the very asset class they were rating. 18 months later, those AAA-rated mortgage securities had lost 90% of their value, triggering the 2008 financial crisis that destroyed trillions in wealth worldwide. Moody's real estate investments became worthless alongside the securities they had rated, but by then the mathematical impossibility of accurate risk assessment had already demonstrated itself through the systematic collapse of independent evaluation. When credit rating agencies started rating themselves, literally evaluating the same asset classes in which they held financial interests, they eliminated the mathematical foundation that makes risk assessment possible. Independent evaluation requires evaluators who have no stake in the outcome. Once agencies became participants rather than observers, accurate risk measurement became mathematically impossible, regardless of analytical sophistication or statistical methodology. This wasn't isolated regulatory failure or temporary market distortion. This was systematic elimination of the mathematical relationships that make accurate risk assessment possible. When evaluators become participants, evaluation becomes advocacy. When judges become players, judgment becomes impossible. The mathematical objectivity required for accurate risk assessment disappears permanently once conflicts of interest reach sufficient levels. The historical function of credit rating agencies emerged during the early 20th century to solve information asymmetry problems that made capital markets inefficient and dangerous for investors. Before independent rating agencies, investors had no reliable way to assess default risk for bonds issued by companies or governments they knew nothing about. Markets were limited to local relationships where direct knowledge made risk assessment possible. Credit rating agencies solved this problem by creating independent analytical institutions whose only revenue source came from providing accurate risk assessment to investors. Agencies that provided accurate ratings gained credibility and market share. Agencies that provided inaccurate ratings lost clients and revenue. Market forces created mathematical incentives for rating accuracy because agency success depended entirely on investor confidence in rating reliability. This mathematical relationship between accuracy and revenue created what economists call aligned incentives. Rating agencies made money only when their ratings helped investors make profitable decisions. If ratings were consistently wrong, investors would stop paying for them, forcing agencies out of business. The mathematical feedback loops ensured that rating accuracy remained high because inaccuracy became economically fatal. The system worked effectively for nearly a century because mathematical relationships between rating accuracy and agency profitability remained aligned. Standard & Poor's, Moody's, and Fitch built reputations based on providing independent, accurate assessments that helped investors avoid losses while identifying profitable opportunities. Their success depended entirely on maintaining mathematical objectivity in risk evaluation. But during the 1990s, fundamental changes in rating agency business models began eliminating the mathematical relationships that had made accurate rating possible. Instead of earning revenue exclusively from investors who purchased ratings to make investment decisions, agencies began earning increasing percentages of revenue from issuers who paid for ratings on their own securities. This shift created mathematical conflicts of interest that made objective evaluation impossible. When agencies earned money from entities whose securities they were rating, mathematical incentives shifted from accuracy to favorability. Agencies that provided favorable ratings to issuers earned more business than agencies that provided accurate but unfavorable ratings. The mathematical feedback loops that had ensured accuracy for nearly a century were reversed to reward bias rather than objectivity. The mathematical impossibility of maintaining objectivity under these incentive structures became obvious through the ratings inflation that occurred throughout the 2000s. As issuer payments became larger portions of agency revenue, average ratings increased dramatically across all asset classes. Securities that would have received B or BB ratings under traditional evaluation standards began receiving A or AA ratings under the new business model. This ratings inflation wasn't conscious deception or regulatory violation. It was mathematical inevitability that occurred when incentive structures made favorable ratings more profitable than accurate ratings. Agency analysts genuinely believed their upgraded ratings were justified by improved analytical models and better risk understanding, but their conclusions were systematically biased by business model changes that made objectivity mathematically impossible. The mathematical progression toward systematic rating inaccuracy accelerated as agencies became direct participants in the markets they were evaluating. When Moody's began investing in real estate markets while simultaneously rating mortgage securities, the mathematical conflict reached levels that made objective evaluation impossible, even with perfect analytical intentions. Agency employees who knew their company held substantial real estate investments faced subconscious psychological pressure to interpret ambiguous data in ways that supported real estate market stability. Analysts who might have questioned mortgage underwriting standards or housing price sustainability were psychologically discouraged from reaching conclusions that would damage their employer's investment portfolio. This psychological bias operated below conscious awareness because most agency employees genuinely believed they were providing objective analysis. The mathematical impossibility of maintaining objectivity while holding financial stakes in rated assets created systematic analytical distortions that appeared as legitimate differences in professional judgment rather than conflicts of interest. Standard & Poor's demonstrated identical patterns through their equity investments in technology companies during the dot-com boom, while simultaneously rating technology sector bonds. Agency analysts consistently provided favorable ratings to technology securities throughout the late 1990s, even as mathematical indicators suggested unsustainable valuations and business models. The mathematical relationship between S&P's technology investments and their technology sector ratings created feedback loops that made accurate risk assessment impossible. Unfavorable ratings would have reduced technology stock prices, damaging S&P's investment portfolio. Favorable ratings supported continued technology investment inflows, benefiting both S&P's direct investments and their rating fee revenues from technology issuers. These feedback loops created mathematical incentives for maintaining favorable ratings regardless of underlying risk realities. Each favorable rating justified continued investment in the sectors being rated favorably. Each investment created additional incentive for maintaining favorable ratings. The mathematical progression made systematic overrating inevitable once agencies became market participants rather than independent observers. Fitch Ratings followed similar patterns through their expansion into advisory services for the same institutions whose securities they were rating. When agencies began earning consulting fees from issuers for advice on improving their credit ratings, the mathematical separation between evaluation and advocacy disappeared completely. Agency consultants who earned fees for helping issuers achieve higher ratings faced mathematical conflicts when those same issuers requested ratings from agency rating departments. The consulting revenue created financial incentives for providing favorable ratings that validated the advice being sold through consulting services. This integration of advisory services with rating services eliminated the mathematical independence that made objective evaluation possible. Agencies earning money from helping issuers achieve specific rating levels could not simultaneously provide independent assessment of whether those rating levels were mathematically justified by actual risk characteristics. The European sovereign debt crisis demonstrated how agency conflicts of interest created systematic blindness to obvious mathematical problems. Moody's, S&P, and Fitch maintained favorable ratings for Greek, Spanish, and Italian government bonds throughout 2009 and 2010, while simultaneously expanding their European operations and seeking additional government contracts for analytical services. Agency employees knew that unfavorable sovereign ratings would damage relationships with European governments whose business they were pursuing. Mathematical analysis that showed unsustainable debt trajectories and fiscal imbalances was systematically discounted in favor of optimistic assumptions about government reform capabilities and economic growth potential. The mathematical impossibility of providing objective sovereign risk assessment while seeking business from the same governments created analytical blind spots that persisted until market forces made rating downgrades unavoidable. By then, investors who had relied on agency ratings had suffered enormous losses that accurate independent evaluation would have prevented. Current ESG rating systems represent the ultimate evolution of agency conflicts of interest because ESG ratings explicitly evaluate subjective social and political criteria rather than mathematical risk factors. When agencies rate companies based on environmental, social, and governance factors while simultaneously selling ESG consulting services and holding ESG-focused investment portfolios, the mathematical possibility of objective evaluation disappears entirely. ESG rating agencies earn revenue from companies seeking higher ESG scores, investment firms marketing ESG products, and government entities promoting ESG compliance. These multiple revenue streams create mathematical conflicts that make independent evaluation impossible because unfavorable ESG ratings would damage multiple business relationships simultaneously. The mathematical result is systematic ESG rating inflation that bears little relationship to actual environmental, social, or governance performance. Companies that purchase extensive ESG consulting services consistently receive favorable ESG ratings regardless of their actual practices. Investment products that pay higher fees receive more favorable ESG classifications regardless of their actual environmental or social impact. This systematic bias in ESG ratings creates information asymmetries that make efficient capital allocation impossible. Investors relying on ESG ratings cannot distinguish between companies with genuinely superior environmental practices and companies that simply pay more for favorable ratings. Capital flows to companies with better ratings rather than better practices, reducing environmental improvement incentives while increasing rating manipulation incentives. The mathematical problems created by agency conflicts of interest extend beyond individual rating errors to systematic market distortions that affect entire economic systems. When rating agencies become market participants rather than independent evaluators, market pricing mechanisms lose access to objective risk assessment information that efficient capital allocation requires. Without independent risk evaluation, capital flows are determined by marketing effectiveness rather than mathematical risk-return relationships. This creates asset mispricing that accumulates over time until mathematical realities force correction through crisis events that destroy far more wealth than accurate rating would have preserved. The 2008 financial crisis demonstrated this dynamic through the systematic overrating of mortgage securities that channeled trillions of dollars into housing investments that mathematical analysis would have identified as unsustainably risky. The crisis wasn't caused by random market forces or regulatory failures. It was caused by systematic elimination of independent risk assessment that made accurate capital allocation impossible. Current market conditions suggest that agency conflicts of interest have reached levels that exceed anything observed before the 2008 crisis. Rating agencies now earn revenue from issuers, advisory clients, investment portfolios, government contracts, and regulatory consulting simultaneously. These multiple revenue streams create mathematical conflicts that make objective evaluation impossible across virtually all asset classes. The mathematical relationship between accurate risk assessment and market stability means that systematic rating bias creates systematic market instability. When ratings consistently overstate asset quality, investment flows create bubbles that must eventually correct through price collapses that destroy wealth and economic stability. Understanding agency conflicts of interest as mathematical impossibility rather than regulatory problem provides insight into why reform efforts consistently fail to restore rating accuracy. Regulatory changes that attempt to manage conflicts of interest while maintaining multiple revenue streams cannot solve mathematical problems that require mathematical solutions. Independent evaluation requires evaluators whose financial success depends entirely on evaluation accuracy rather than evaluation favorability. Any business model that creates financial incentives for favorable rather than accurate ratings makes mathematical objectivity impossible, regardless of regulatory oversight or professional ethics standards. The mathematical solution requires separating evaluation revenue from issuer payments, investment returns, and advisory fees. Rating agencies must choose between earning money from accurate independent evaluation or earning money from favorable ratings and related services. Mathematical objectivity cannot coexist with financial participation in evaluated markets. But implementing mathematical solutions faces political obstacles because agency conflicts of interest benefit multiple constituencies simultaneously. Issuers prefer favorable ratings that reduce borrowing costs. Investment firms prefer favorable ratings that support asset values. Rating agencies prefer multiple revenue streams that increase profitability. Government regulators prefer avoiding market disruption that accurate rating might create. The mathematical necessity for independent evaluation conflicts with political preferences for market stability and business profitability. This political mathematical tension typically resolves through market crisis that makes rating reform unavoidable. But by then, systematic mispricing has created economic damage that prevention would have avoided. International competition may eventually force rating system reform as markets with more accurate risk assessment attract capital away from markets with systematically biased evaluation. But competitive pressure operates slowly while rating conflicts create immediate and ongoing capital misallocation that reduces economic efficiency and increases systemic risk. The systematic elimination of independent risk assessment through agency conflicts of interest represents civilizational regression from mathematical objectivity to subjective advocacy in financial evaluation. This regression makes efficient capital allocation impossible while creating systematic conditions for recurring financial crises. Historical analysis demonstrates that civilizations advance through institutions that provide accurate information for decision-making. Credit rating agencies originally represented advancement toward mathematical objectivity in risk assessment. Their transformation into conflicted market participants represents regression toward subjective bias that makes rational capital allocation impossible. The mathematical relationships that make accurate risk assessment possible don't negotiate with business models or regulatory preferences. When judges become players, judgment becomes impossible, regardless of analytical sophistication or professional intentions. The mathematical foundation for objective evaluation disappears when conflicts of interest reach sufficient levels. Current agency conflicts of interest have reached mathematical thresholds that make accurate risk assessment impossible across virtually all asset classes and market sectors. The judges are now players in every game they're supposed to judge. Mathematical objectivity has been eliminated through business model changes that make bias more profitable than accuracy. When credit rating agencies started rating themselves, evaluating assets in which they held financial interests, they destroyed the mathematical foundation that makes risk assessment possible. The systematic elimination of independent evaluation guarantees systematic market mispricing that must eventually correct through crisis events that destroy wealth and economic stability. The mathematical impossibility of accurate evaluation under current agency business models means that systematic rating bias will continue until market forces make reform unavoidable through crisis events that demonstrate the economic costs of eliminating independent risk assessment. When the judges start betting on the game, everyone loses through systematic information distortion that makes rational economic decision-making impossible.